The richest country on earth, defaulting like some banana republic? That's impossible to even imagine, right? But what if I told you that we've come dangerously close to the US defaulting on its debt multiple times in 2011 and 2023? And if it ever actually happens, it won't just crash Wall Street. It'll crack the foundation of the global economy. Because US debt is the invisible glue holding the entire world economy together, and the consequences of the US default would be harder than anyone could imagine. By the end of this video, you'll understand why every person on Earth, yes, including you, is betting their financial future on one thing: that America keeps its promise of paying debt. And if you want to understand the world before it cracks, subscribe. Part 1. What does default even mean? Okay, first things first. What does it actually mean for the US to default on its debt? Think of it like this. When you borrow money from a bank, you sign a contract that says, "I'll pay you back on this date, plus interest." If you miss that payment, you've defaulted. Simple. The US government does the same thing, just at a much bigger scale. It borrows money by selling treasury bonds. These are basically IOUs that say, "Give us your money now, and we promise to pay you back in 5, 10, or 30 years with interest." Who buys these bonds? Everyone. Your grandma's pension fund, China's central bank, your own 401k, Japan, Saudi Arabia, regular Americans. They're considered the safest investment on planet Earth. So when we talk about the US defaulting, we're talking about the moment when the government misses a payment on those bonds, when it can't or won't pay back the people it borrowed from. And here's the wild part. It's not that America doesn't have the money. It could pay every bill tomorrow if it wanted to. The problem is that Congress has to give permission first. See, there's this thing called the debt ceiling. It's a limit that Congress sets on how much money the government can borrow. Think of it like a credit card limit, except Congress controls the limit and has to approve every purchase. When the government hits that ceiling, it can't borrow more money to pay its bills. Even if those bills are just paying back money it already borrowed. That's basically what happens during a debt ceiling crisis. If Congress doesn't raise that limit in time, the government eventually runs out of cash, and that's when the risk of a default becomes real. The money exists, the will to pay exists, but the political permission? That's where things break down. Part 2. How close are we actually? Now you're probably thinking, okay, but this is just theoretical, right? America would never actually let that happen. Wrong. We've been dangerously close. Multiple times. Like in 2011, Congress was fighting about raising the debt ceiling. Republicans and Democrats couldn't agree. Days passed, then weeks. The deadline got closer and closer. Treasury Secretary Tim Geithner started using extraordinary measures, basically accounting tricks to keep the lights on a little longer. He was moving money between government accounts like someone juggling credit cards to avoid late fees. Financial markets started sweating. Investors were asking, wait, is the US actually going to do this? And then, for the first time in American history, the credit rating agency Standard & Poor's downgraded the US credit rating from AAA to AA+. That's how the safest borrower in the world just got a mark on its credit report. Markets lost trillions of dollars in value within weeks. Interest rates jumped, retirement accounts tanked, all because politicians were playing chicken with the global economy. They eventually raised the ceiling at the last second. Crisis averted. Everyone breathed a sigh of relief. But the damage was done. That downgrade is still there. The world learned something new that day. America could default. Not because it was broke, but because it might just choose to. Fast forward to 2023. Same story, different Congress. Another debt ceiling fight. The Treasury was days away from running out of cash. Janet Yellen, the current Treasury Secretary, said June 5th was X date, the day the money runs out. They cut a deal on June 3rd, 2 days before the disaster. And here's the scary part. It's going to happen again. The debt ceiling isn't a one-time thing. Right now, in 2025, US debt is over $38 trillion. The government pays nearly $1 trillion a year just in interest. That's almost as much as the entire defense budget. And Congress did it again. In July 2025, they voted to raise the debt ceiling by another $5 trillion, pushing America's official borrowing limit to a staggering $41.1 trillion. That didn't solve the problem, it just kicked the can farther down the road. So, technically, America is borrowing money just to pay interest on money it already borrowed. The machine still works, But it's grinding louder every year. And every time Congress threatens not to raise the ceiling, the world gets a little more nervous. Because one of these days, they might not blink. Part 3. The day everything breaks. So let's imagine it actually happens. The unthinkable. Congress deadlocks. Negotiations fail. The Treasury runs out of tricks. And one Tuesday morning, the United States misses a debt payment. It wouldn't look dramatic at first, but behind the scenes would be absolute chaos. Let's look at this one by one. Number 1. Markets freeze. Treasury bonds are the backbone of the entire global financial system. Banks use them as collateral for loans. Pension funds rely on them for stability. Every mortgage rate, every credit card interest rate, every car loan, all trace back to Treasury bonds. If Treasury bonds aren't safe anymore, nothing is safe. Within the first hour, trading algorithms would start panicking. Stock prices would plunge. Not because companies are doing badly, but because the foundation of future value just cracked. Number 2. The dollar collapses. Foreign countries holding trillions in US debt would scramble to protect themselves. China holds over $800 billion in treasuries. Japan holds over $1 trillion. They'd start selling. Fast. Investors would flee into anything that looks stable. Gold, euros, Bitcoin, even Swiss francs, anything but dollars. The dollar, which was the king of currencies yesterday, is now being treated like trash. And when the dollar crashes, everything priced in dollars crashes with it. Oil, food, electronics. Your salary might be the same number, but it buys half as much. Number 3, your life falls apart. Interest rates would skyrocket overnight. Your credit card APR doubles. Your adjustable rate mortgage becomes unaffordable. Want to buy a car? Good luck finding a loan. The government can't pay its bills. Soldiers don't get paychecks. Social Security checks bounce. Medicare stops paying doctors. Federal employees are sent home. Grocery stores start running low on imports because international suppliers don't want dollars anymore. Number 4. Global cardiac arrest. International trade grinds to a halt. Supply chains collapse. Countries that depend on dollar-denominated trade can't complete transactions. Your retirement account would be down 50%. Your company's stock would tank. Your job? Maybe gone, because your employer can't make payroll. Pension funds around the world lose half their value. Millions of retirees suddenly can't afford rent. Are you still wondering why all of this would happen? Part 4. How did we get here? So how did the richest country on earth end up in a situation where it could destroy the global economy with a political tantrum? The story starts way back in 1790. America had just won the Revolutionary War, but it was completely broke. The new government owed money to soldiers, citizens, and foreign allies. Most countries in that situation would have just said, "New phone, who dis?" and walked away from the debt. But Treasury Secretary Alexander Hamilton had a different idea. He said, "Let's not only pay the debt, let's embrace it." He argued that if America could borrow money and actually pay it back reliably, the world would see it as trustworthy. A safe bet. It was a gamble, but it worked. America started issuing bonds. Investors bought them. Confidence grew. That trust became America's superpower. Every major leap forward, the railroads, the Industrial Revolution, and World War II, was financed through borrowing. Debt wasn't a weakness, it was rocket fuel. By the mid-1900s, that engine was running the entire planet. In 1944, 44 countries gathered in Bretton Woods, New Hampshire, and made one decision that changed everything. They anchored the global financial system to the US dollar. After World War II, America held 2/3 of the world's gold and half its industrial output. The dollar became the ultimate safe investment. Foreign governments stored dollars as reserves. American debt literally became the world's savings account. Then in 1971, President Richard Nixon did something wild. He severed the dollar's link to gold. Suddenly, money wasn't backed by anything physical. It was backed entirely by confidence, by the belief that the US would always pay its debts. That belief created what we live under today, the debt standard. Treasury bonds became the safest asset on earth. The system worked because of one simple ritual. When old bonds mature, America issues new ones. It never truly pays off the debt. It just rolls it over, forever. As long as that process continues, everything's fine. But if the chain ever breaks, If the government misses even one payment, the illusion shatters instantly. And now, in 2025, that chain is held together by increasingly fragile political agreements. The trust that took 250 years to build can vanish in 24 hours. Part 5. The slow death. But here's the thing. A sudden catastrophic default probably won't happen. What's more likely is a slow-motion collapse of faith. Every debt ceiling fight chips away at credibility. Every near miss plants a seed of doubt. Every year of political circus makes investors a little more nervous. Other countries are already hedging their bets. China, Japan, and Saudi Arabia have quietly started trimming their treasury holdings. Central banks are buying gold again. Brazil and India are exploring trade deals that don't use dollars. It's not a dramatic break, it's a quiet retreat. And that's how empires actually fall in the modern world. Not with wars or declarations, with diversification, with caution, with indifference. The world doesn't fight the dollar, it just stops needing it as much. History has seen this before. Rome's currency collapsed when people stopped believing in Rome. Britain's pound lost its status when the empire faded. The United States built its power on a paradox: infinite debt backed by infinite trust. For now, that trust still holds. But faith, like any currency, depreciates when you abuse it. And every time the debt ceiling drama plays out on TV, the world watches and thinks, maybe we shouldn't put all our eggs in this basket. Part 6. The lesson. So what's the lesson here? US debt isn't just numbers on a spreadsheet. It's the foundation of your daily life. It's why you can get a mortgage, swipe a credit card, and trust that your paycheck tomorrow will buy roughly the same stuff it bought today. That entire system depends on one invisible thing: trust. Not gold, not armies, not even money itself. Just trust. And here's the terrifying part. Trust is the one currency no government can print. No central bank can create it. No bailout can restore it once it's gone. If America ever truly defaults, whether through chaos or choice, it won't just break promises to bondholders. It'll shatter the illusion that's held the modern world together for 80 years. The good news? It hasn't happened yet. The system is still standing. The world still believes. The bad news? Every year of political games and financial brinkmanship brings us one step closer to finding out what happens when that belief runs out. So next time someone casually says, "Just don't pay the debt," remember this: the world doesn't run on money. It runs on trust. And we've got plenty more mind-blowing stuff coming your way. See you next. Thanks for watching.